Hi there, Peter Russell from Supertax. Thanks for watching another one of my video blogs. Today's topic is part 2 of the taxation of employee stock options here in Canada. We're going to do a walkthrough of an example of how to calculate the tax components of a stock option transaction. So let's go to the big board. Okay, employee stock options. For this example, we're going to assume that our individual is a Canadian resident, deals at arm's length with this corporation, and this corporation is public. For this example, we're just going to call this company Apple Corporation. Now, it's not the real Apple company, but because the values are obviously different from the real Apple Corporation, but just for this example, we'll call it Apple Corporation. So the fair market value of the shares on the date of grant of his option, September 1st, 2010, for Apple Corporation is $5. Now, his options vest June 1st, 2011. He has the right to purchase an additional 20,000 shares of Apple Corporation. The exercise price that he can purchase them at is $7. Now, once we get to June 1st, our fair market value of Apple Corporation will be $12. So definitely when it gets to June 1st, he definitely has a benefit to his advantage. So he's going to exercise his options. Now, he's also going to sell these shares on November 1st when the value of the shares are $19. So now we got to calculate the tax components of this transaction. We first got to calculate the option benefit. This is worked out as follows. 20,000 times $12, which is the fair market value on June 1st, works out to 240,000. We subtract the exercise price, which is 20,000 times $7 is $140,000. That difference is our option benefit income inclusion of $100,000. That would be reported on line 101 of his T1 General Canadian Income Tax Return. Now the second component is the option benefit deduction, or section 110(1)(d). That works out to 1/2 of the benefit, which is $50,000. He is definitely eligible because the exercise price of $7 is greater than or equal to the fair market value on the date of the grant of the shares, $5. Plus, he's also a Canadian resident. He's dealing at arm's length. So he's definitely eligible for that section 110 deduction. That would be reported on line 249 of his income tax return, bringing him down to taxable. Basically, it's a deduction from net income for tax purposes to taxable income. Now we have to calculate the capital gain on the sale of these shares. So he's going to sell these shares at $19. So we got to calculate 20,000 shares times 19, $380,000. We deduct the adjusted cost base. Now, how do we get the adjusted cost base? That's essentially what he paid for right there, the optional benefit calculation, $240,000. That's made up of two amounts. That's what he originally paid for it, the $140,000 plus the benefit he's taken into income on line 101. So 100 plus 140 is 240. That is our ACB for our capital gain calculation. We subtract from 380,000, 240,000, giving us a difference of $140,000. That is our capital gain. Now, the taxable portion of that capital gain is only 50%, which is $70,000. That would be reported on line 127 of your T1 General Canadian Income Tax Return. Now, the tax effect in total on this transaction is as follows. $100,000, the optional benefit, deduct the option benefit deduction of $50,000. We got to add the taxable capital gain. That works out to a total of $120,000. So if this individual was in the high bracket, which means he earned over $130,000 a year, so he's being taxed in Ontario, because I'm located in Ontario, at a taxable rate of 46.41, he would pay income tax on 46.41% of $120,000. Okay, so that's just a basic example of a calculation of the tax calculation on a stock option transaction. They definitely do get more difficult than this, but this is a start for your education. If you have any questions or comments, please feel free to leave them below, or you can send me an email at peter@supertax.ca. Thank you very much.